This meeting is being recorded.
For those of you who have joined, just give us a few more minutes. We're going to allow just a minute or two for additional registrants to log into the meeting, but we'll begin shortly. Manali, I think we could go ahead and start. People will still trickle in, but the attendance has slowed down a little bit. So let's go ahead.
Okay, thank you so much, and welcome to all the participants to today's webinar, where we are presenting the finding from the study on the market and opportunity assessment for mobilizing private sector participation and investment to support the energy sector transition in South Asia. The presentation findings would also be followed by a very enriching discussion with select group of experts from South Asia, representing think tank, financial institution, as well as private sector. John Smith Serene, IPO director, USAID, was supposed to give the opening remark, but however, he's held up because of unavoidable circumstances. He will be joining a little later, and after the presentation, he will be offering his remarks. We did this a study with the intent that it would give out opportunities for private sector to focus on in South Asia, where several interventions are happening. Each of these countries have NDC target, and a lot is happening. So plenty of opportunities for private sector. This report will highlight some of these findings, some of the challenges, and then we hope that the panel discussion will give you some idea about the opportunities as well as challenges for the private sector. I am delighted to welcome. I'm delighted to welcome our colleagues from PwC who did this study for us. I'm also like to thank USEA, which is the implementing partner for South Asia Regional Energy Hub, the erstwhile South Asia Regional Energy Hub, and also to USAID's program South Asia Regional Energy Partnership, which has provided technical inputs to this particular study. So with that, let me pass it back to Sarah. I do hope that you will find this presentation and discussion very enriching. Thank you, and passing it back to Sarah.
Thank you, Manali. So Manali kind of outlined the agenda for today, but what we will be starting with is about a 35-minute presentation from PricewaterhouseCoopers, who implemented the actual study, who conducted the study. And this was many months process, and they put a lot of work into it, reaching out to a wide variety of stakeholders in the region. And they'll get into a little bit with that on their presentation. If you have any questions during their presentation, I encourage you to put them into the Q&A whenever you think of them. And then when we transition over to the panel discussion, we will deal with the Q&A questions at that time. And some of them we will answer just written responses for everyone to see if that's simplest. Others we will give an oral response. So that's about it. I now pass over the baton to our PwC Supersheet. If you could take over.
Yes. Sarah, sorry, this is John Smith Serene. I just want to let folks know that I'm back and have joined. So,
perfect, John.
Whenever it makes most sense for the program.
No,
sorry,
now is perfect. Now is perfect. If you're willing to make your remarks
okay?
now.
Are you sure?
Nope. This is perfect timing. I'm so glad you joined.
Okay, wonderful. So for those of you who don't know, I'm in the U.S. Embassy in Delhi, and right at the start of this, they launched a test of our emergency system. So we all had to evacuate. So people that knew I was supposed to be speaking with you all were quipping, oh, hope you're speaking on adaptation and resilience. And I said, no, I'm speaking on market assessments and private sector engagement in clean and renewable energy. But nonetheless, I'm just really happy that I was able to finally join you all and all the esteemed speakers and distinguished guests and participants from all across South Asia and other parts of the world joining today. As many of you know, the U.S. government launched what we call the 2022 Indo-Pacific strategy, and that supports an Indo-Pacific that is free and open and prosperous and connected and secure and resilient. And we plan on fostering this type of environment by partnering with countries all across the Indo-Pacific and quite frankly, all across the world that are working on things like clean energy transition and systemic reforms and expanded economic development and increased private sector participation and investments. And the private sector, as you well know, has such an important role for sustaining equitable and inclusive economic growth throughout the Indo-Pacific. And USAID, the organization I work for, recognizes this fact as an intrinsic part of our development planning. And we therefore actively engage with the private sector to maximize the impact of our joint investments. USAID's private sector engagement strategy seeks to unlock the potential of private capital to drive inclusive growth. But it's not just financial resources from the private sector that are important. It's really the creativity, the ideas, the networks, the business processes, which are often more nimble than government bureaucracies, that the private sector can bring to the mix and that contribute to success. And therefore, across our various portfolios, USAID focuses on creating an enabling environment that encourages stronger private sector engagement. And in this case, of course, our focus is on the deployment of clean and renewable energy and other advanced energy technologies, as well as the promotion of tools and approaches that can reduce investor risk. Increasingly, private investors are looking to South Asia for better returns and new market opportunities. And to meet nationally determined contributions, the climate ambitions from these countries, NDCs so-called, countries are looking to significantly enhance financing for climate mitigation and adaptation measures. And most South Asian NDCs make specific reference to private sector engagement. That's such an important component. Under the Biden-Harris administration, the United States has recommitted to working with countries all across the world on climate ambitions. And it's estimated that South Asia represents a 3.4 trillion climate investment opportunity. This is if we take the years from 2018 through 2030. And that's across multiple sectors, including renewable energy, large hydro, green buildings, electric vehicles, and municipal solid waste. But today, there's still great scope for improvement in terms of the role the private sector can play in realizing these NDCs, countries' climate ambitions. And the scale of the challenge to achieve energy security goals and the corresponding opportunity that challenge creates means that governments need to better ignite private sector solutions and investments, and public financing needs to be used as a catalyst to attract more private resources rather than replace private financing. Which brings us to the purpose of today's event, the study on market and opportunities assessment for mobilizing private sector participation and investment to support the energy sector transition in South Asia, has attempted to identify some of these critical financing gaps and to recommend financing and non-financing interventions to address these gaps, to support countries such as Bangladesh and Bhutan, Nepal, India, the Maldives, and Sri Lanka in their renewable energy and climate change commitments. And over the course of our gathering today, you'll hear from energy experts who will share the key findings of this report, and then we'll broaden the discussion with eminent leaders from the private sector, from financial institutions, think tanks, to explore these challenges and opportunities. And before we jump into the report's findings with our colleagues from PricewaterhouseCoopers, let me extend our thanks first to the U.S. Energy Association for leading this report, and of course, in particular to Sarah Blandford, who's the Deputy Program Director at USEA. USEA has been a long-time partner of USAID, and I've personally engaged with them during the course of my career at USAID over the past 22 years. And I can attest that we work quite well together, and we really appreciate the support. I'd also like to thank the team from PricewaterhouseCoopers for authoring the report. PwC has partnered also with us on other ventures as well, including a recent gas study in South Asia, and we very much appreciate their ongoing support. And finally, appreciation to our colleagues from USAID South Asia Regional Energy Partnership for their support in reviewing and providing input on the report. I'd also like to acknowledge and thank our eminent panelists for joining us in today's discussion. Jiwan Acharya from the Asian Development Bank, Dr. Ram Krishna Katawada from the Nepal Infrastructure Bank Limited, Arpana Mangla from the British International Investment, Vivek Sen from Climate Policy Institute, Mozammel Hussain from Summit Power, and our moderator today, Mayank Bardawaj from SAREH. And most importantly, I want to thank all of you, the audience, for joining today. We truly hope you find this report useful and the discussion insightful, and thank you for including me. Back to you, Sarah.
Thank you, John. I'm glad they fast-tracked your little test run there. It was great to have you aboard. All right, I'm now going to pass the baton over to our PricewaterhouseCoopers team. Subhrajit, you can take over from here.
Thank you, Sarah. Thank you, John, for that introduction. So good evening, everybody. Just a short introduction. I'm a director in PwC India's Energy Utilities and Resources Advisory Practice. And I focus on investments, governance, and sustainability aspects related to clean energy transition and regional cooperation in energy sector. Today, I'm happy to present to you a short summary of this study report that we have prepared for USEA and the USAID. Market and Opportunities Assessment for Mobilizing Private Sector Participation and Investment to Support the Energy Transition in South Asia. I'll also be joined by my colleagues Tushar Kothavale, who is an Associate Director, and Baljit Singh, who is a Senior Associate in PwC's Energy Utilities and Resources Practice. So I'll start by setting the context briefly for this study that we have conducted with USAID and USEA under USAID SAREH programming. My colleagues will then take you through the current clean energy landscape for the 6 countries covered in this study: Bangladesh, Bhutan, India, Maldives, Nepal, and Sri Lanka. Subsequently, I'll discuss some of the key financing and non-financing interventions that have been identified to address the risk and challenges that the South Asian countries face in their transition towards a cleaner and greener energy mix. So let us move on with the key study objective, which was, as John elaborated, was to identify gaps and opportunities in the South Asian region and interventions which can help in addressing this identified gaps in clean energy transition and financing. So the report was prepared based on a mix of in-depth secondary research, primary interactions with a wide range of stakeholders, and of course, strategic analysis of opportunities. So one key differentiating factor of this report is that this is just not an analytical desktop research-based report, but it factors in the real challenges that investors, financiers, and other strategic stakeholders are facing in financing clean energy transition in South Asia. Let us now quickly set the context before presenting further details on the study. The South Asian region, if you see, has more than 20% of the world's population and economically is one of the fastest growing regions. However, if we see the per capita electricity consumption, it is still around 1,000 kilowatt hour per capita, which is around 1/3, even lesser than 1/3 of the global average actually. The region is also witnessing increasing CO2 emissions, with the power sector accounting for almost 44% of such emissions. There is also high vulnerability to climate risk and other natural disasters. Many of the countries face these risks. Moving on to the energy mix, there is a huge diversity also in the energy mix for each of the countries. So for example, if you see hydropower rich countries like Nepal and Bhutan have a very high proportion of renewable energy in their energy mix. While on the other hand, if you see Bangladesh and Maldives, they are still heavily dependent on fossil fuel-based generation sources. India, I mean, all of us are aware, India has witnessed significant renewable energy capacity addition over the last 10 years. But again, on the other hand, if we see the NDC targets and RE commitments, there is a clear focus of policymakers towards clean energy transition for each of the countries. Let's take a couple of examples. Sri Lanka aims to achieve 70% RE generation capacity by 2030 from a current around 40 to 45, 50%, and also increases forest cover. Well, if you see Bangladesh, which is still not having enough RE capacity, Bangladesh aims to increase its capacity 10 times by 2041, while at the same time reducing GHG emissions by more than 6.7% below business as usual levels by 2030. So that is broadly the context of the study. In the next section, my colleagues will present to you a snapshot of the clean energy landscape in the 6 countries and discuss the key risks, uncertainties, and financing gaps. Over to you, Tushar.
Thank you, Subhrajit. In this section, we will briefly cover the country-wise assessment of renewable energy and advanced energy system market, covering broad landscape, business operating models, investment trends and outlook, risk and uncertainties and financing gaps. We'll start with the first country, Bangladesh. Bangladesh has been making strides in scaling grid-connected solar, though the existing installed solar capacity of 553 megawatts is just 2% of the total installed generation capacity. The draft National Solar Energy Roadmap lays a roadmap for increasing the grid-connected solar capacity in Bangladesh's overall energy mix. Bangladesh is import dependent for both solar PV cells as well as modules, and the new advanced energy systems like battery energy storage systems and electric vehicles. IRCOL, in partnership with the World Bank, has been instrumental in supporting the scale-up of off-grid and decentralized energy resources in Bangladesh. In the solar rooftop space, the capex-based ownership model is the most dominant business model in Bangladesh. In the next slide, we'll look at the past trends of investment and the current existing trends, risks and uncertainties, and the financing gaps. The past trends of investment show a skew towards investors favoring fossil fuel-based power project infrastructure in Bangladesh. And this is mainly attributable to the government policy supporting fossil fuel-based power stations. Our study, however, identified commitments of over $1.1 billion from various multilateral agencies and climate investment themed funds. The key risks identified includes lack of land availability, slow pace in receiving permits and licenses, limited availability of domestic credit, and a comparatively low sovereign rating. The key financing gaps includes lack of domestic options for renewable energy lending, and a lack of comfort and experience by domestic lenders in financing renewable energy projects. We will now move to the next country, Bhutan. Bhutan's power sector is dominated by hydropower sector, which contributes to around 20% of Bhutan's gross domestic product. Because of its strategic nature, the hydropower sector is controlled by the royal government of Bhutan entities, namely Druk Green Power Corporation and Bhutan Power Corporation. Our study identified commitments of over $254 million from various multilateral agencies and bilateral commitments from neighboring countries. The alternate renewable energy policy in the making is likely to drive the investments in renewable energy and advanced energy system space. The key risks identified includes unforeseen geological challenges in commissioning of hydropower projects, uncompetitiveness of other renewable energy technologies against the hydropower exports subjected to market forces, and regional geopolitics. The key financing gaps that we identified includes limited domestic financing options, high dependence on development finance institutions and bilateral commitments, and a lack of dedicated financing of non-hydro renewable energy. We now visit our third country, which is India. India has experienced a steady increase in solar photovoltaic capacity with approximately 6 gigawatts of annual capacity addition over the last 5 years. This growth is attributed to availability of affordable financing and targeted government policies on supply and demand side. India also has a thriving solar photovoltaic cell and module manufacturing base, which is primed by the government policy initiatives such as production linked incentives, PLI, and is protected by trade barriers in the form of import duties. Wind power sector in India also experienced a very steady growth over the last 4 decades, which was supported by uh, feed-in tariff regime in place. However, this regime was abolished in 2015, which resulted in aggressive auction prices leading to muted capacity additions and consolidation in the wind turbine manufacturing sector. In 2019, the Indian government formulated hydroelectricity policy. The policy aims to support uptake of hydropower projects. The policy has helped change status of newly commissioning large hydropower projects to renewable energy for the consideration towards renewable energy purchase obligation for the obligated entities. The policy also aims to rationalize tariff for making hydropower competitive with respect to other energy sources. The policy also has proposes budgetary support for enabling infrastructure such as building roads, bridges, etc., and also for flood moderation and storage hydroelectric power stations. India has set a target of 152 gigawatt hour of battery energy storage systems by 2030. In 2020, National Program on Advanced Chemistry Cell was launched. This program was launched with an aim to promote local manufacturing of battery energy storage systems in India. Under this program, a PLI scheme was launched in 2021 with an intention to support local manufacturing industry with payout of $24.7 billion over the next 5 years. In the electric vehicle EV space, India today has more than 380 manufacturers. Thanks to the policy initiative, faster adoption and manufacturing of electric and hybrid vehicles in India, short form FAME, F-A-M-E. It has been supporting the supply and demand sides through the various interventions. The FAME2 scheme was launched in 2019 with a budgetary allocation of $1.3 billion. The scheme focuses on demand side incentives to buyers of EVs, interventions for accelerating pace of setting up EV charging stations, and supporting EV manufacturers. In the hydrogen space, the Government of India notified Green Hydrogen Policy in February 2022. In the recent past, many domestic and international companies have expressed plans for investments to scale up hydrogen-related infrastructure in India. The investment outlook paints a very promising picture in the advanced energy system space in the coming few years. Our study identified investment commitments of over $10 billion by 2030 in the Indian renewable energy space from various financing entities. The battery energy storage systems market is estimated to grow to around $15 billion by 2030, while the electric vehicle EV market is estimated to grow to around $150 billion by 2030. The key risk identified includes poor financial health of DISCOMs, lack of business models for the new and emerging technologies, legal issues in land acquisition, and delays in obtaining statutory clearances. The key financing gaps includes increased off-taker default risk, input cost variations due to various factors like currency depreciation, inflation, and geopolitical tensions. My colleague Baljit will take you to the next few set of countries. Over to you, Baljit. Thank you.
Thank you, Tushar. So Maldives RE installed capacity is dominated by the solar power with the POISE project, the preparing outer islands for sustainable energy development, contributing the maximum to the solar capacity. Another 36 megawatt solar PV and 50 megawatt BESS projects are in the pipeline. Our study identified commitments of over $386 million from various DFIs. The key risks identified in Maldives include vulnerability to climate change, limited technology options, and availability of skilled labor. The key financing gaps includes weak public sector financing and high dependence on soft loans and grants. A direct ownership model is dominant while the public-private partnership model is still an emerging model in Maldives. Moving on to Nepal, Nepal's power sector is dominated by the hydropower sector, accounting for approximately 93% of total installed capacity. Nepal is planning to increase its installed capacity from 200 megawatts in June 2022 to 15,000 megawatts by 2030. 30% of electricity supplied in rural areas is through the decentralized energy sources, which comprise of biomass, biogas, solar PV, micro hydro, etc. In Nepal, EVs are imported, whereas they are also granted special EV tariff. The Nepal Electricity Authority operates large-scale hydro assets, whereas some medium and small-scale hydro assets are privately owned. Our study has identified commitments of over $353 million from various DFIs. The key risks identified include unstable political climate, inadequate policy, and regulatory support for the private sector participation, including bureaucratic hurdles and perceived corruption, which may lead to time and cost overruns. The key financing gaps include limited domestic capital pool, sectoral lending limits, which restrict the domestic lenders' ability to finance large-scale hydropower projects, and weak currency hedging markets and hesitation of banks towards non-recourse lending. Moving on to Sri Lanka. 53% of Sri Lanka's installed power generation capacity is from renewable sources, out of which more than half is from hydropower sources, with grid-connected solar, wind, and other sources contributing to the remaining RE capacity. Sri Lanka is exploring setting up of utility-scale solar and wind parks. The Surya Bala Sangramaya program, launched in 2016, envisions installation of 1 gigawatt of rooftop solar by 2025, of which 425 megawatts has been achieved till 2021. Recently, a 100 megawatt Thamba Pawani wind park, which is to the south of Mannar Island, was commissioned with the assistance of ADB. Utility scale RE projects are mostly owned by the state-owned enterprise, the Ceylon Electricity Board, CEB. There are a few private sector players owning RE assets in Sri Lanka. Despite the recent economic turmoil, the investment trend in the clean energy sector is robust, with recent investments in the 800 megawatt solar PV and 500 megawatt onshore wind projects in Sri Lanka. Our study identified commitments of over $1 billion from various DFIs in the clean energy sector in Sri Lanka. The key risks identified include depreciation of currency, change in law related risks that are passed on to the RE developers, high indebtedness of the CEB, which causes payment delays. The key financing gaps identified includes limited domestic capital pool, sectoral lending limits restricting domestic lenders' ability to finance RE projects and the current macroeconomic crisis which affects financing. Now, Subrajit will take you through the next couple of sections. Over to you, Subrajit. Thank you.
Thanks, Tushar and Baljit, for very succinctly discussing the clean energy landscape across all the 6 countries covered in our study. In this section, I'll cover a few financing instruments and interventions that are likely to be useful to address some of the identified financing risk and challenges, which was just now discussed by Tushar and Baljit. So, but before we get into those recommended financing instruments, let me just quickly take you through some of the existing instruments which are used by several financing institutions, including US government's Development Finance Corporation, or DFC, who were one of the key stakeholders of this study, and also the applicability of this instrument in facilitating energy transition in South Asia. So just to give a background, the DFC partners with private sector to finance solutions to the most critical challenges facing the development work today. And the suite of products that they offer, like any other, most other multilateral development agencies are, debt, equity, investment funds, political risk insurance or guarantees, and technical assistance support. So in terms of debt financing, this study identifies that there are several possibilities, some of which are listed here. So for example, to provide lines of credit to local domestic banks for renewable energy projects in Nepal and Bangladesh, partner with consortium of financial institutions to fund utility scale projects, for example, in Sri Lanka, provide debt to utilities, for example, in Maldives, for developing emerging technologies and innovations like renewable energy along with BESS projects. And also another example, like providing debt support to consortium with other MDBs for financing hydropower projects in Bhutan. In the private equity infrastructure fund space, there are also tremendous opportunities. So for example, potential investments in RE investment platforms that provide access to diverse RE assets across India, or maybe subscribe to issue of bonds from infrastructure financing institutions in Nepal or Bangladesh. In the equity financing space, there are actually several mid-sized players with whom we interacted and who are into solar PVs or other emerging technologies, advanced technologies like battery manufacturing, electrolyzers, EVs, etc. And many of them are actually looking for equity financing. There is also opportunity to provide political risk insurance or guarantees in some of the countries where foreign private sector developers avoid investing due to high perceived political risk. So there are also opportunities to provide technical assistance, for example, in developing advanced energy technologies, in developing geothermal power, ocean energy systems, commercial scale biogas technologies, etc. One of the important aspects that are emerging is storage projects, and in fact, pump hydro storage projects, which is one of the matured solutions. So there are opportunities to explore potential sites, for example, in Nepal to develop such projects. So moving on, how do we define innovative financing instruments before getting into discussing the financing instruments? So there is no internationally agreed definition, but some of the definitions considers and covers the requirement that is there from this financing instrument. So for example, there is a definition by World Bank which says that considers 2 aspects: generating additional development finance beyond conventional mechanisms by tapping new funding resources, and enhancing the efficiency of financial flows by reducing delivery time and costs or being results oriented. So when we have developed the financing instruments as recommendations, we have considered broadly these 2 factors. So we have considered 6 financing instruments, and from the next slide, we'll discuss those instruments. Let's start with aggregation platform and marketplaces. So this is a project sourcing aggregation platform which can aggregate renewable energy projects. So for example, solar rooftop projects from multiple developers and package them together into larger deal sizes. So this helps in addressing portfolio risk by reducing the financing cost that small scale projects have, because there is an economies of scale in financing these projects at an aggregated basis. And also it helps in reducing the transaction cost for the financials. So this can support initial efforts for a country which is getting into different generation sources, maybe at a smaller scale. So for example, Bhutan, which is looking to diversify beyond hydropower and planning to develop solar rooftops and other such solutions, or even for Bangladesh, which is also looking at ensuring energy security and broadening its supply base. The next mechanism is a carbon credit mechanism. So most of us must be aware, so much recent discussions around carbon credit mechanisms globally and also in India. So, so this may be established through measurement, reporting, and verification to unlock private sector capital from developed nations to finance clean energy transition. The returns for private sector will be in the form of carbon credits that will help them offset their GHG emissions and achieve the goal of net zero. This can also help in addressing the high cost of techno-commercially viable low carbon technologies, which is a key barrier towards financing and adoption. This would be particularly true for markets where these technologies are yet to be tested at a commercial scale, so more applicable for Bhutan, Nepal, Sri Lanka, or Maldives. A notable example of such a mechanism for financing is the Japan Fund for Joint Crediting Mechanism, which was established in 2014 and is being managed by the Asian Development Bank. So this was a key enabler for funding the Maldives POISE project, about which my colleague discussed. So other MDBs, multilateral development banks, or international development agencies can also establish similar carbon credit mechanism fund soliciting investments from private sector corporations who are interested in ESG investing and earning carbon credits. Next, we'll talk about asset-backed securities. Securitization, as we know, is a process by which assets that have fixed, predictable cash flows are bundled together into financial product called a security and sold to investors who then carry a portfolio risk instead of a single project risk. This can help countries like Bangladesh, which has no other institutions offering preferential or lower rate of interest for RE projects, apart from ITCOL, of course. So this can help to adopt a portfolio approach and get discounted finance refinance. Besides, this can also address the barriers related to unattractiveness of small projects to international and national equity investors and for banks, which has a high transaction cost for financing such small projects. The next, infrastructure investment trust, again, a lot of discussions recently. These are legal entities into which developers bundle together and hold operational infrastructure assets. Operational projects, as we know, carry a lower risk than projects that are yet to be constructed. Therefore, by offering shares in these operational projects, developers can attract investors with expectation of lower rate of return and lower risk appetite. On the other hand, by reusing the capital freed from the sale of shares, the developers can pass on the benefit to the new renewable energy projects. In India, private sector developers are keen to experiment with InvITs, and there is a substantial scope to monetize operational assets to this for mobilizing private investments. On the other hand, in Nepal, Bhutan, Sri Lanka, no regulatory mechanisms exist for InvIT, and currently the markets are actually not deep enough to support such instruments. There are opportunities to provide assistance to help develop these markets, for example, in Nepal, in Bhutan, or in Sri Lanka. Next, let us discuss currency risk hedging facility. So we know all the South Asian countries have experienced a devaluation of their currency against the US dollar in the past decade. And this is a key barrier being faced by foreign financiers and investors. The currency hedging facility would determine the threshold of currency depreciation. For example, say like up to 5%, which the foreign debt provider will have to bear. Beyond this threshold of currency depreciation and up to a user-specified upper limit, say up to 10%, the coverage will be provided by a currency call spread underwriter. There will be a subsidy provider, usually a development finance institutions, will have to make an upfront call spread payment to cover the range bound protection between 5 to 10%. These are just examples. The numbers are just examples. When currency depreciation is lower than expected, the benefit will remain with the hedging facility and can be returned either to the currency hedging facility provider or the foreign debt provider after the tenor of the transaction. The transaction will require two separate tripartite contract agreements with the project developer and the foreign debt provider. The currency risk hedging facility can be introduced selectively for high impact projects that face foreign risk variation as an insurmountable problem to unlock private sector capital in the renewable energy sector. This is we are not recommending a blanket use of this product. Next, and the last one, is the first loss protection guarantee, which protects or provides insurance for a certain percentage of capital against a financial loss due to default on an outstanding financial obligation. For example, a distribution utility to generator or a CNI consumer to a developer. This can either be in the form of insurance that can be purchased by the financier or the asset owner, or it can also be in the form of a guarantee fund sponsored by a third party, for example, a government or again, a development finance institution, to cover the potential losses the financiers can access at no cost. In cases where the instrument is in the form of the guarantee, the government DFI deploying the instrument will be required to bear the cost. In cases where the instrument is in the form of insurance, the project developer would typically bear this cost. This instrument can help private sector rooftop developers access finance at low risk for not so credit-worthy tier 2 and tier 3 CNI consumers. This can also be applicable for other countries in the region, Nepal, Bangladesh, Sri Lanka, and Maldives, so where sovereign guarantee may not be available or applicable in certain cases. Moving on to the last section, we have also recommended a few non-financing interventions which can help in this energy transition. So the non-financing interventions are categorized into technical assistance, capacity building support, or reform programs, which can provide momentum to this transition. So broadly, under technical assistances, we identify that there are opportunities to provide assistance regarding PM Kusum scheme or on workable business models in EV ecosystems. In issuance of green government securities in India, attracting private capital for the energy CPSEs. The DRE in Bhutan on development of advanced weather monitoring stations and real-time generation forecast, and also in enhancing grid resilience through technological interventions that is applicable for many of the provinces also in India. For capacity building, there is a clear need for training and skill development programs for key staff in commercial banks in many of the countries like Bangladesh, Sri Lanka, and Maldives for building technical skills for assessing the RE projects. Under reforms in the areas of policy, institutional, etc., some of the important requirements felt were, for example, assisting the PPP office in Bangladesh in preparing standard bid documents for RE procurement along with the PPP contracts. This helps in scaling utility scale RE sector. Also for example, in Nepal, where a lot of industry structure related reforms might be helpful in facilitating the clean energy presentation. So that's all with our presentation. We have come to the end, and I really want to thank everybody for their time. To optimize the time, and as Sarah mentioned, we'll encourage participants to type in their questions in the Q&A section. So I'll now hand over to Sarah and Mayank subsequently for the panel discussion.
Thank you, Superjit. Your team did an excellent job of taking a very large report and skimming it down to something that we could all have a few takeaways in just about a half hour. Mayank, I think we will pass the baton over to you now. We'll begin a panel discussion, as we mentioned earlier, with a handful of key experts who will have a discussion on kind of next steps and what this study means for the region. And everyone just post your questions in the Q&A and we'll fold those into the discussion as we go along. Mayank, over to you.
Sure. Thank you. Thanks, Sarah. Good evening, everyone. So thanks, Subrajit, for this, for the presentation, and thanks, John, for setting the context as well regarding the study. So primarily we have a elite panel right now. So we have to discuss some of the risks, challenges, and possible solutions which are there, which have come out of the study, and we just thought that we will try and follow up this presentation with a panel discussion wherein we can discuss some of the major challenges and also possibly try and provide some solutions or at least discuss about those solutions and see how much of them can actually fit into the various financing instruments which Subrajit just mentioned. So with that, I'll just introduce the panel which is there. So we have Vivek Sen. He's Associate Director from Climate Policy Initiative. We have Mr. Ram Krishna Kathiwada, CEO of Nepal Infra Bank. We have Mr. Muzammal Hussain, who's the Managing Director for from Summit Power in Bangladesh. Aparna unfortunately could not join in. I think there was some last minute urgency which had come up, because of which she was not able to join. Also, I don't see Jeevan as of now there. So we'll, in the interest of time, we'll just start off and just, I'll just post some of the questions which I have to the panels. I would request, as already mentioned by Sarah and Subrajit, you can put your questions there in the chat box, and I'll just go through after the first round. I'll come back and see and pose your questions also to the panel. So with that, we'll just start off. So just from the perspective of Subrajit, what the PwC presented, basically the operating models, the investment trends, outlooks, risks, certainties, financing gaps, etc. Now, I just invite some of these experts to just share their views around that, those aspects as well. So Vivek, I think maybe Arunabha, if you can just stop sharing it, I think it'll be better to have the panelists on the screen. And I would just request all the panelists to, whenever they're speaking, to just switch on the camera so that we'll just it brings just a bit of a thing on this. Yeah, thanks Arunabha. So Vivek, I think we'll just start off with you. As I've seen, so in your view, and you have done a lot of research in this area, climate policy as well. So what, in your view, are the major risks and challenges with regards to financing of these clean energy projects in South Asia?
Thank you, Mayank, for that question, and I would request you to kindly allow the video for me, because I cannot click that button. I think it has been stopped by the moderator.
Sarah, maybe you can help with that.
Yeah, I'll work on that. Go ahead, and I'll try to figure out where that button is.
So starting off, I think when you talk about financing clean energy projects or infrastructure in general, we can classify the risks into 2-3 brackets. One is the macroeconomic risks. And this is particular to the fact that for the last few years, we have seen COVID ravaging impacts on the economic conditions of many of these Southeast Asian nations. The extreme example is Sri Lanka, where you have seen it's a mix of COVID plus decisions that have not been conducive for the economy as such, but we have seen it to the verge of sovereign default. Similarly, Bangladesh, Pakistan have been seeing their forex reserves dwindling down. So economies in general in Southeast Asia have been impacted by COVID, and COVID caused inflation as such. So macroeconomic risks are one which generally affect the uptake of infrastructure development in the country. The second one is the political scenarios in this country, so political risk. Many of these countries do not have a stable regime. For private sector to flow into such countries, the regime should be very much stable. And the example to that is that Indian regime is far more stable as compared to the countries, 6 countries that you have compared just now. You would see a lot of private sector investment coming into India. The other example, extreme example I can take is London, or the city of London, which is considered to be the one of the most stablest financial place on the earth, where you will find offices of all the major financial institutions. That's because of the political stability that the government or the regime brings in. So we lack that in Southeast Asian nations. The third is lack of access to finance, and this has to do a lot with the innovation that is sought out by innovation and the risk return profile that is sought out by the private sector in these countries. So you took example of various instruments that can be tried, various innovative instruments that can be tried, say in Nepal, say in Bangladesh, or anywhere else. I'll give you a few examples. India, among all these countries, is one of the most stable economy. We haven't seen an InvIT in the solar domain as of now in India. When you talk about distributed renewable energy, the first aggregation and securitization facility was attempted by IFC in 2016, and it never took off. CPI was the consultant for that. The FX hedging facility, there are no long-term swaps available. And secondly, there are no guarantors who can provide a guarantee cushion for managing the sovereign, the currency risk and the deviation because of the risk associated with the fluctuation of the rates. So even in a country like India, the instruments are not available. And that brings me to the fourth risk. The capital markets, and especially the debt side of things in these countries, are underdeveloped. These are shallow. This makes it very difficult for private sector investors to apply into these markets and ask for stable returns or even look for stable credit profiles. Now, this makes it very difficult for any investor to actually bring in money into infrastructure sector or especially energy sector. And there are few associated risks as well. The policy stability, which is needed in long run, which attracts private sector. There is a lot of demand on standardization of contracts and the asset classes in which these investments would be happening. The tradability of asset classes is another big factor which the private sector or the investees generally look into when they make an investment call. So I think these are some of the major things or major risks that are preventing investments into infrastructure sector into Southeast Asian region. I'll stop here.
Sure. Thanks, Vivek, for that. And I hear you. You know, primarily from a macroeconomic perspective, to the maturity of the capital markets, to the maturity of the instruments. I think that's I think what you're trying to refer here, which in a way is very important, especially to attract international capital into these countries, which in a way is going to be essential to fulfill their clean energy commitments in the next 8 to 10 years. So thanks, I think, Vivek, for providing that perspective. Now, just to open it up, I'll just go to Mr. Hussain. So Mr. Hussain, you know, Vivek talked about a lot on the macroeconomic factors and on the financing gaps which are there. Now, as a private developer in Bangladesh, what do you feel, or what sort of challenges you have faced, and especially if you can cover with respect to raising capital and raising international capital, I think that will be really helpful.
Thank you for giving me this opportunity to join in this very thoughtful session. So, in fact, as you know, transition towards renewable or more specifically to new technologies, yeah, started or maybe in Bangladesh perspective, it started very recently because you see, although the private sector investments in power generation, it started basically in late 90s or maybe from 2001 we started. But you see, in Bangladesh, it was agriculture-based economic country. So, in fact, the generations available in the earlier days, yeah, it was mostly on our own energy resources or primary energy from gas. So about 85% of the, in fact, power generations were coming until 2009-10, yeah. It was mostly dependent on our own natural gas. So, in fact, from 2009 or 2010 onwards, we thought that maybe the gas reserves will be, in fact, not enough to, in fact, mitigate, to cover up the future demands. So from then, our country started with mixed fuel generations. So in that respect, you see at the time also in 2010 until 2016-17, the coal prices or even if the LNG prices in the international market was very, very reasonable or affordable. So until 2015-16, in fact, as the demand scenario was also not very high, so we started developing our country, mostly the conventional fossil fuel generations. So, in fact, though for, in fact, transition or in fact moving towards renewable energy, they started from 2015 onwards. But at the time also, we found that in fact, investment cost in this or return is more in fact comfortable with the fossil fuel generations, and because of the fact that the technology is known to us and our people, and there was less risks in fact procuring or getting the primary energies. So for that reason, there was more in fact move towards developing the conventional power generations. But now you see, with the after the COVID and with this present international scenario, or the economic recession due to this war, we find that this conventional or fossil fuel energies are also becoming costlier compared to this renewable energies development. So now, in fact, from basically from 2021-22, yeah, our country is very, in fact, rapidly thinking of going towards the transition to these renewable sources. But the main risk factor in Bangladesh is that in fact, for solar, we don't have sufficient land compared to our population. You see, for about 170 million of population, and in fact land area, if you consider, there's much constant is on the land. So we also in fact evaluated and we see even if the land prices is about 50% of the project cost for a solar project, yeah. So for that reason, though some of the solar projects have been taken mostly from the private sectors, but it is not in very larger scales. Maybe it started with 3 megawatt or 10 megawatt, 30 megawatt like this. Large scale investment is still not very much possible due to scarcity of land, yeah. So this is the one risk that is also in fact happening in India for solar power generation. In fact, tariff comes, or in fact, per unit generation cost is near about 3 cents or maybe less than 3 cents. But in Bangladesh, if we consider, in this report also, it has been forecasted that Bangladesh, there is no PV panel manufacturers, we need to import. And with this imported equipment and then with the land costs, it is becoming maybe 3 times or 300 times compared to Indian prices. Yeah, that is the risk, and we need this mitigation. How to mitigate? Yeah, maybe we need some more incentive, maybe more support from the government measures about, or in fact incentives towards reducing the cost, maybe more tax benefits, or maybe you see in Bangladesh also, we are having very less, if you consider per capita emission, CO2 emission, if you consider, it is less than 0.5% per capita. So in that case, in that respect also, Bangladesh can expect more that a climate change fund, support, because as we are, per capita consumption emission is very, very low. So that is also, in fact, financial support is needed to, in fact, mitigate that investment cost, so that we can really think over of transition towards renewable. And very recently also, you see, between these 6 countries, India also definitely is leading. So there are discussions going on to explore more opportunities in sharing the renewable energies from Nepal, Bhutan, maybe wind and this hydro energies, or from India even, from this hybrid type of solar plus wind energies. But Bangladesh can import. But you see, we need also this more transmission facilities from India towards all the countries, and also from Nepal, Bhutan, if you can have some dedicated transmission connections, transmission line connections to Bangladesh. Then there are investors also, private investors like Summit. Summit, though the #1 now in Bangladesh, but you can see that about 70 private companies have been developed from 2009 towards now, and then we have these capacities of investments. Maybe we can also, from Summit also, we can also invest in India with partnership in renewable energies, or in Nepal or Bhutan also. But again, we need some comfort of getting this generation through this grid system of India to Bangladesh. That facilities also is a constant to move forward, because in Bangladesh, due to land scarcity or land constraints, we cannot develop much solar energies, or even no hydro resources also available. And then you see very limited wind speed or wind resources for wind power. So these are the constants of the risks. So risk is to, in fact, a high project cost. That is the main risk. And others also, you see, as in this study also, it has been reflected that as Bangladesh government are very recently, very aggressively moving on towards this transition, but the conventional power purchase agreements or the contracts, because still in fact, the merchant type of distribution system is not yet developed in Bangladesh. The power purchaser is the only BPDB or the government. So in that case, the PPA also need to be modified to, in fact, attract more these renewable energies. So that is also a right thought has been reflected in this report. So again, with this, I'd like to end my first views on this. So if any questions are further, I can again answer to those questions. So thank you for giving me the opportunity again.
Sure, sir. Thank you. So I hear you. So basically, what you're talking about is the initial transition, which was there. So the dependency on the fossil, and then it moves on to the high investment costs, the high tariffs, and then I think what Subhajit also mentioned, the land. The land requirement and the availability of land in Bangladesh also is significantly affects this entire clean energy transition from coal based to the RE. And also I understand about the financing gap which you're mentioning, that the current tariffs are in that region, maybe there is difficulty in achieving grid parity and their economies of scale, etc., are not coming in, which can really drive down the tariffs, which possibly has happened in a case in India, wherein the economies of scale, the gigawatts capacity addition was really responsible, and it brought down the overall costs. So I hear you, sir. I think that thanks a lot for giving your views on this. And maybe now I'll just again go to some perspective as well as on Nepal as well, to just understand that from a bank perspective, how do you see or this entire clean energy space in Nepal shaping up, and what do you see are the ways in which possibly a bank or a financing institution can help or accelerate this transition? So over to you, Mr. Ram.
Yeah, thank you, Mike. First of all, yeah. First of all, thank you, USAID and the USEA for inviting me to this seminar. It is obviously indeed a great pleasure to participate on the most needed discussion on the private sector participation in the energy transition. And I would say it's the energy integration among the BVIN region. So in terms of financial arrangement in the renewable energy sector, especially hydropower in Nepal, basically done through two set of mechanism. One, obviously, direct lending from the commercial bank and the financial institution because of the directive lending. The Central Bank of Nepal has clear policy that commercial bank and the financial institution, especially development bank, including infrastructure bank, has to commit some level of investment in the renewable energy sector, and here mostly on the hydropower sector. And out of the total investment, total credit offtake right now is around 40 billion, and out of that, till now 6%, which is around 3 billion investment is made by the commercial bank and financial institution to those energy projects, especially on the generation side. And the second is obviously the other sources is contractual saving, especially employment provident fund, CIT, retirement fund. Those are also the one of the major player in the Nepalese financial context. But realizing the going larger way of the project development and the energy transition in the South Asia region, we need to have a larger investment, because the current appetite of the financial institution is also reducing, and even contractual saving also is not in the very larger quantum, because the current contractual saving situation is roughly around $10 billion in the different institutions, and they have already invested around 500 to 600 million dollars to the energy sector, and even we don't suggest to them to put their money in the single sector, that is energy sector. So obviously we have to look on the different alternative financing mechanism in Nepal. So for the having the larger energy transition, we are seeing that there are the much opportunity in the international market, which is obviously even in the presentation also elaborated, especially in the green financing, because recently in 2021, the ICMA, the regulator entity, especially on the green bond or bond framework, that has included the hydropower sector of any size of project or any nature of the project that can be qualified in the green bond framework. So this is the kind of the creating the very good opportunity to have a long-term investment avenues in the investment in the larger infrastructure or larger energy infrastructure project. And the energy infrastructure, we have to focus on the integration of the generation, transmission, and the trade, because the current Nepali, especially Nepalese market demand is quite low. It's around only 2,000 megawatts, and our target, as you pointed out in the presentation, also that by 2030 we are exploring to have the generation capacity of the 15,000, and by 2040 around 40,000 megawatts. So for that, the local demand will not be basically sufficient to address the whole generation capacity. So in this context, we need to have the regional integration on the investment and the financing mechanism also, or regional collaboration is required, especially Bangladesh. Basically is rightly pointed out by the Bangladesh colleague that there are some momentum building on the Bangladesh interest in the Nepalese hydropower sector. For that also we need to have the financing solution or the financing mechanism to have those type of the project development in Nepal. So considering all these factors, we need to have the alternative financing mechanism. We need to have the blended finance approach, especially on the developing of the transmission line and larger storage or the peaking kind of the project. And also parallelly, we have to look on the international market, bilateral and multilateral agencies, as well as most importantly the capital market, because the nature of the capital market is to provide the long-term source of the financing. And even you pointly the report also pointed out that the InvIT could be the one area to look for the sourcing the larger quantum of the financing in Nepal using the international as well as local resources. Mike? Hello?
Sure. Yeah,
Yeah.
sure. Thanks, sir, for that perspective. Now, and you've rightly pointed out some of the ways or some of the things which can possibly be utilized in this. And if you see the report, the current report which was prepared by PwC, it also talks about some of the areas, and for example, a lot of those areas have been, or a lot of those instruments have been successfully implemented in India for energy transition. And you've seen the demand aggregation has been developed, in which a couple of InvITs are there. Obviously in the infrastructure sector, they have been quite successful in a sense. RE, as Vivek already pointed out, not many have actually come up. So in those respects, just to tell, a follow-on question on this. What do you feel? How possibly or on what instruments? How do you interact international capital? In a way into Nepal, or if you have any views on South Asia as a general, because international capital in any case will be required in a large context. So from that perspective, any views on any how this international capital can be attracted?
Yes, because for having the international capital, there should be some level of the integration of the ecosystem, because one of the major breaks we are facing is currency hedging. Because without sorting out the currency hedging problem over here in Nepal, even international finance is quite challenging, because in the energy sector, the revenue stream is locked, and the asking them to come on the open position, it would be not the justice to them, and even they will not be interested. So in this context, even NIFRA and the Ministry of Finance jointly working on having a currency hedging solution. And right now Ministry of Finance is appointing one nodal agency for managing the currency hedging, especially on those larger investment, larger interest, and that is one area. Second is obviously green bond. We have been working from very beginning, because NIFRA has started working on the green bond from the 2020 itself, and right now we are focusing on having the regulatory framework so that the international issuance of the green bond would be successful, especially from the two angles. One is obviously sovereign, because NEA being the entity, they do have a larger quantum of the project and the larger quantum of the renewable energy project that can be monetized, and the issue sovereign green bond, that is one one area, and the second is corporate level green bond, like financial institution level or the private sector green bond is also another area that is going on. And the third major instrument we are seeing, and in fact we have been working with the regulator also, is InvIT, because for the especially for the attracting the larger quantum of financing from the local as well as international level, with especially larger institutional investor who are not very much interested to go on the construction risks and basically looking on the investment opportunity, having the commercial operation projects. So monetizing those assets and creating the InvIT instrument, it would be the right approach. And in fact, we have been working with the regulator and the relevant stakeholders also. Mayank?
Sure, sure. Thank you. Thanks a lot, sir, for this. I think, you mentioned currency hedging and obviously green bonds and InvITs as some of the instruments in which, you can work. Now, possibly if I come, yeah, Vivek, I was actually in any case coming to you only, just to, so maybe if you want to respond first and then maybe I can ask a question.
I have a very quick point to make to what Ram said. See, the sovereign risk, I think, is the main criteria by which the financial institutions judge the credibility of the economy and at what rate they have to lend into. The credit risk profile of the country, if you just compare two countries, say, for example, one in Europe and one in South Asia, it is very easy for the lenders to add 200, 300 basis points just based on the sovereign credit rating of the country. So essentially what needs to be done, I do understand that these are important instruments, like raising a bond, and you might be inviting monies through by providing guarantees and everything, managing the currency risk. These are instruments, but what really needs to be done to attract capital into a country is to clearly define the role of domestic financial institutions. And I will give you anecdotal evidence for that. Like when infrastructure was supposed to be created in India, we created an IFCL. When renewable energy was supposed to be promoted in India, we created an IREDA. These are NBFCs, right? And that was the right model, because what it did was it was able to attract capital and act as a apex institution in that particular sector. Now that made it very easy for international financing institutions, whether they were institutional investors or private investors, to look at the country from a point of view where the risk can be managed, because these apex financial institutions are essentially an arm of the government itself, right? That will reduce your credit rating or credit risk from, say, 300 basis point to probably 50 basis point. Now that makes the country itself very attractive for capital to flow in. So that is my limited assumption.
I think well taken. I think that's a very important point which you brought in, Vivek, about the specific financing institutions for specific areas and focus areas, and then those financing institutions really in a way create the market or help the market transition towards commercial principles. So yeah, I think thanks a lot. I actually had a question for you in respect of the private participation. So you might have looked at the various ways in which private participation has happened in the clean energy space or in an infrastructure space in general. So what in your views can be done really to enhance some of this participation or private participation into the clean energy space in South Asia? So some measures or some changes in case you have any.
So I'll continue. So this, for me, the starter is you cannot deepen or broaden your capital markets over a decade, right? That takes its own sweet time. So to really attract finance into countries which are in South Asia, and I'll continue from the point where I left before, you need to create specific roles for specific financial institutions, because that reduces the risk and it increases the appetite of the investors to come into the country and invest into whether it is energy or any other infrastructure project. Secondly, the investors always look at recurring and steady returns over a period of time. That means the asset class in your country should be well defined. It should have a standardized way of, I should say, reporting, managing the asset class. That gives the institutional or the investors in general a high degree of confidence to come into the country and invest. Even to the extent I would say that which is not so common with the new technologies, but if you are able to demonstrate that in 3-4 years of operations, the returns or the revenue or cash flow from the asset class is pretty much stable and it doesn't vary too much, then the investors would be ready to take a plunge even at a very early stage, right? So they discount the technological risk and still take a plunge into that class of asset. So I think these are two important things. And of course, you need to have a system wherein people are able to do business at a pace which is easier to them, I mean, they shouldn't be hassled, right? At the end of the day, they are not coming into the country to get hassled because of various laws, jurisdiction, and everything. So this is another point which I think which is very critical from a foreign investor's point of view to come into a country and then do business or invest into the country.
Right. Thanks, Vik. So I'll just maybe move, in the interest of time, I'll just move and pose my last question to Mr. Hussain. Sir, you have been, one of the major developers in Bangladesh, and you have, invested across very heavily. What and just an extension of the question to Vivek, what in your views, and since you are the private developer, what in your view can be done so that which encourages the private developers like yourself to really come in and invest into these the clean energy projects? Mr. Hussain?
Yeah, pardon, I couldn't follow. So can you repeat? Any question?
Sir, so I was just saying that, Vivek already laid out and provided some insights into what can be done, from how to enhance the role of private investors or private developers. So in your view, sir, what can really encourage you as a developer to really come up and invest into heavily, if not heavily, but yeah, invest more into this the clean energy space in Bangladesh? So maybe some 2 or 3 things which you feel are very crucial or very critical to encourage you for investments.
In fact, as I have also mentioned before, this in fact rapid transition, it started very recently. So first thing is our capacity is not enough. Yeah, capacity development in terms of technology is very much in fact it need to be enhanced. Yeah, so some projects in the initial stages maybe you see in Bangladesh, I think more than 25 projects have been awarded since from 2017 to 2020-21. But very less have been actually implemented. Yeah, so that also reflects that the capacity was lagging. Yeah, for developing or taking up this project or implementing this project, and in fact, other around, you see the cost of investment, yeah, need to be reduced, yeah. And then as the land cost is too much in Bangladesh, or land is the main constant, so we can also think over to have new technologies so that in the same land we can develop hybrid type of multiple use of this land. Yeah, maybe you see there are some about 81 or more than 80,000 square kilometer of wetland, yeah, or maybe water land covered with water, maybe river or other thing. So we may go for floating solar on the, in fact, water bodies. Yeah. So that also our people and definitely in the private sector still we have no knowledge. We are just listening, and in summit, from summit also we are trying to make some studies on floating solar power system, or taking up also some pilot project initially, very small scale, maybe 100 200 kilowatt. We are thinking of, yeah, to in fact develop ourselves. So this support also will help us, yeah, from USAID or anywhere. So that will help to in fact move forward. So, and also to have more information. So this is floating solar on water bodies is okay, but whether we can also go for using the same land, maybe keeping the some of the agriculture products, maybe some vegetable or fruits under the solar panels, whether it is possible. So that also a very unknown system. So this type of research development also need to be done for in fact taking off further solar projects in Bangladesh. So sure. These 3-4 things you can enhance in fact taking up projects by private sector in Bangladesh.
Thank you, Zain sir, for this, and I think it really helps. You know, the somewhat like maybe I can just think of India example again. Maybe not biased, but yeah, an example like the SECI land banks and the solar parks which are there, and floating solar I think is a great idea, which is also picking up across South Asia. So maybe I think. It was thank you, you know, Mr. Hussain and Vivek and Ram sir for, you know, for providing your views. I think they were really insightful. We are run out of time, and it really helps me because I don't have to summarize now, and I can really pass it on to Sarah. Sarah, so over to you. I think for this, and thanks a lot. I think it was really a pleasure to moderate this session and, you know, listen to your views. So over to you, Sarah. Thank you.
Thank you, Mayak, for doing that, for leading that roundtable discussion on the next steps and our forward roadmap following this report. I'd like to thank our panelists for taking the time today to join us for their on-the-ground perspectives. Your unique outlook has, I think, given everybody here a lot of food for thought, and hopefully we can take some additional steps forward on this discussion. Last but certainly not least, I want to thank PricewaterhouseCoopers for working with us on this project. They brought a wealth of knowledge into this project, and the quality of the report showcases that, which, speaking of, we will be disseminating that to all the registrants probably later today or early tomorrow. Feel free to share it with your colleagues and anyone else you think might be interested. And we thank everyone for joining today and for taking the time. And we hope you all have a good holiday and a good rest of your evening. Thank you so much. See you next time.
Thank you.